Welcome back to the show. Today we're talking about one of the most common questions taxpayers have when filing a US federal income tax return. Should I take the standard deduction or should I itemize my deductions? To help us understand the difference, I'm joined by our tax expert Pachi. Welcome to the show.
Yeah, thanks for having me. This is an important topic because the choice between the standard deduction and itemizing can affect how much of your income is subject to federal income tax.
Okay, so let's start with the basics. What exactly is a deduction?
A tax deduction generally reduces the amount of income that is subject to federal income tax.
Okay.
Think of this way. If you have $80,000 dollars of a taxable income before deductions and you qualify for a $50,000 deduction, the taxable income could be reduced to $65,000, assuming no other adjustments or limitations apply. For individual taxpayers, one of the major choices is between taking the standard deduction or itemizing deductions.
Okay, so what is the standard deduction then?
So the standard deduction is a fixed dollar amount that most taxpayers can subtract from their adjusted gross income when calculating taxable income. The amount depends on factors such as your filing status and in some situations your age or whether you are blind. For example, a taxpayer filing a single generally has one standard deduction amount, while a taxpayer married filing jointly has a larger amount.
Okay.
The important thing is that standard deduction is relatively simple. You don't have to list individual qualifying expense to claim it.
Okay, so that sounds pretty straightforward. What about itemized deductions?
So itemized deduction work differently.
Okay.
Instead of taking one fixed deduction, you add up certain qualifying expenses and deductions that you may be entitled to claim. Common examples can include certain medical and dental expenses, state and local taxes, mortgage interest, and charitable contributions, subject to applicable rules, limits, and eligibility requirements. You generally claim itemized deductions on Schedule A, which is filed with your federal income tax return.
Okay, so is the rule simply whichever number is bigger, that's what you should take?
That's a basic idea for many taxpayers, but there are some important details. Generally, if the total of your allowable itemized deduction is greater than your standard deduction, itemizing may reduce your taxable income more. If your allowable itemized deduction are lower than your standard deduction, taking the standard deduction will generally be more beneficial. But the taxpayers also need to consider special circumstances and whether particular deductions are actually allowed under current tax law.
Okay, so let's make this practical. Can you give us an example?
Absolutely. Let's say Nadia is filing a single. Suppose a standard deduction for the applicable tax year is X dollar.
Okay.
Now imagine Nadia has qualifying itemized deduction totaling Y dollars.
Okay.
If Y dollar is less than X dollar, she would generally be better off taking the standard deduction.
Okay.
But if a qualifying itemized deduction total more than X dollars, itemizing could potentially provide a larger deduction. The actual dollar amount depends on the tax year, filing status, and Nadia's specific circumstances.
You mentioned medical expenses. People sometimes think every medical bill can simply be deducted. Is that correct?
No, and that's a common misunderstanding.
Okay.
Medical and dental expenses have specific rules. Generally, only qualifying unreimbursed expenses that exceed the applicable percentage of adjusted gross income can be included as an itemized medical deduction.
Okay.
So, if someone has $10,000 in medical expenses, that doesn't automatically mean they get a $10,000 deduction. They also need to consider whether the expenses qualify and whether they exceed the applicable AGI threshold.
Okay, so what about state and local taxes? I've heard people refer to something called SALT deduction.
Correct. SALT stands for state and local taxes.
Okay.
Depending on the tax year and applicable federal rules, taxpayers who itemize may be able to deduct certain state and local taxes. However, there are limitations and rules that can change. So taxpayers shouldn't assume that all state and local taxes are fully deductible. This is an area where using the rules applicable to the specific tax year is especially important.
And mortgage interest is another big one, right?
Yes, certain homeowners who itemize may be able to deduct qualifying mortgage interest. But again, there are requirements and limitations. The deduction can depend on factors such as type of debt, when the debt was incurred, how the loan proceeds were used, and the applicable federal limitations. So it's not simply I paid mortgage interest, therefore I can deduct every dollar.
Okay, so let's talk about charitable contributions. How do those fit into itemized deductions?
Qualifying charitable contributions can generally be included among itemized deduction subject to specific rules. Taxpayers should make sure they're donating to qualifying organizations and maintain appropriate records. Depending on the type and amount of the contribution, additional documentation may be required. And one important point, you generally can't deduct the value of your time or services simply because you volunteered.
Okay, that's a good distinction. Now, are there people who might be required to itemize?
There are circumstances where special rules apply, but most taxpayers are making a choice between the standard deduction and itemized deductions. There are also situations where a taxpayer may not be eligible for a standard deduction or whether special rules affect the calculation. That's why taxpayers should look at their individual situation rather than assuming the same approach works for everyone.
Okay, so does filing status make a difference then?
Absolutely. The standard deduction varies based on the filing status. For example, single, married filing jointly, married filing separately, and head of household generally have different standard deduction amounts. There are also an important point for married couples. If spouse files separately, special rules can apply. In certain circumstances, if one spouse itemized, the other spouse may also be required to itemize rather than taking a standard deduction. That's one reason filing status and choice between standard and itemized deduction should be considered carefully.
So, what about older taxpayers?
Taxpayers who are age 65 or older or who meet certain blindness requirements may qualify for an additional standard deduction amount. So, two taxpayers with the same filing status could potentially have different standard deduction amounts depending on their circumstances. Again, the exact amounts depends on the tax year.
Okay, here's another question people often ask. Can you take the standard deduction and itemized deductions at the same time?
For the same federal return, you generally don't choose both as your main deduction. You generally choose either standard deduction or your allowable itemized deduction. However, there are certain deductions that can be claimed separately from standard deduction because they're not itemized deductions. This is an important distinction. So, I can't itemize don't necessarily mean that every possible tax deduction disappears.
Okay, so that's an important point. Let's say someone is preparing their tax return. What's the best way for them to decide?
I would suggest a simple 3-step process.
Okay.
Step number 1. Determine your filing status and applicable standard deduction for the tax year. Step number 2. Gather documentation for potential itemized deduction such as qualifying medical expense, state and local taxes, mortgage interest and charitable contributions. Step number 3. Calculate the allowable itemized deduction and compare the total with the standard deduction. Don't just total the expense you paid, make sure you're calculating the deductible amount under the tax rules.
Okay, so what kind of records should taxpayers keep?
Good documentation is very important. For example, taxpayers may want to keep receipts, invoices, tax forms, mortgage interest statements, property tax records, charitable donation acknowledgements and other documentation supporting their deductions. These specific records needed depend on the deduction. And remember, a bank or credit card statement alone may not always establish that an expense qualifies as a deductible expense.
What are some of the biggest mistakes you see?
There are several. First, people sometimes assume that every personal expense is deductible. That's not true. Second, taxpayers may count an expense that was reimbursed by insurance, an employer or another party. Third, people sometimes confuse tax credits with tax deductions. A deduction reduces taxable income, while a tax credit generally reduces the tax itself. Those are very different benefits.
Okay.
And finally, taxpayers sometimes use deduction rules from older tax year. Tax laws and deduction limits can change, so you should always use the rules for the tax year you're filing.
That's especially important because we're talking about the US taxes and where the rules can change from year to year.
Exactly. And another important point is that federal and state tax rules aren't necessarily the same. A deduction that applies on a federal return may be treated differently on a state income tax return.
Before we wrap up, let's give our listeners a quick summary. If someone remembers only 5 things from today's episode, what should they remember?
So, number 1, the standard deduction is a predetermined amount based primarily on your filing status and applicable circumstances. Number 2, itemizing means adding up qualifying deductions and generally reporting them on Schedule A. Number 3, you generally choose between the standard deduction and itemized deductions for your federal return. Number 4, don't assume every expense is deductible. Eligibility, limitations, thresholds, and documentation matter. And number 5, compare the allowable itemized deduction total with the applicable standard deduction for the specific tax year.
Okay, great advice. So, In simple terms, the standard deductions is usually easier and maybe better choice when your allowable itemized deductions aren't high enough. Itemizing can make sense when your qualifying deductions exceed the standard deduction or when your circumstances make it appropriate. Right?
Exactly. And taxpayers should also remember that the best choice isn't determined by a rule of thumb alone. You want to calculate both options using the rules that apply to your particular tax year and situation.
Pachi, thanks for joining us.
My pleasure.
And thank you for everyone listening. Today's discussion is intended as a general assistance to help you better understand the difference between standard and itemized deductions. If you have detailed, individual specific questions or are unsure which deduction is right for your situation, feel free to reach out to NMG Inc. Our tax professionals will be happy to guide you based on your individual circumstances. For professional assistance, please use the link below to get in touch with us. We'll see you next time. See you.